Hello, everyone. Good evening. How are you doing? Awesome. We enjoying the event? Kind of MC a little bit too. So, we have an amazing last panel. I think we have a keynote before with Sriram. Oh, okay. It's going to be great. So here we have, this is probably the panel that is closest to TradFi, but all these guys have a very deep crypto native soul, and I know most of them. I'm going to do very quick intros here because we don't have that much time, and then we'll just go straight to questions. It's pretty amazing lineup. Seth Gins, managing partner at CoinFund. He leads their liquid investment strategies. Prana Kanade, he is a portfolio manager at VanEck, more on the active side. And David Duong, who's head of research at Coinbase Institutional. My name is David Lawant. I'm head of research at FalconX. So why don't we just go straight to questions? Guys, this is a liquidity panel, and we have an interesting group here because Seth and Pranav, they sit on the buy side. David and myself too, we sit on the sell side. So, I mean, we're obviously related, but sit in slightly different seats. So perhaps my first question will go to Seth and Pranav, and then I'll have a similar one for David. But as this is a liquidity panel, tell me how has the diversity of your liquidity sources changed over the last, let's say, 12 months? Of course, there's exchanges, there's prime brokers, OTC desks, DeFi. I'm not very sure to what extent that is a reality for your investment strategies. So why don't we start talking about that? How has that changed over the last, let's say, 6 to 12 months?
Post FTX, I would say we became hyper aware of where we were trading because of the 90-day preference rule. And basically, if you were trading on some exchange and some exchange went belly up, then you could theoretically be subject to clawbacks if you were taking money in and out of the exchange, right? Where the FTX settlement shook out, I think they gave people the option to settle at a certain amount. So anyways, our realization then was we had to be very careful about the credit quality. But at the same time, liquidity kind of just dried up at that point. So it became kind of this hunt to find, we're more of a fundamental team. We pick tokens that we like. And then rather than say, this is liquid, I'm going to go buy this thing. And so, yeah, it became this kind of puzzle or exercise to figure out where and how to source a lot of our token positions. So we obviously onboard with you guys at some point. We onboard with market makers directly, obviously many OTC providers, all kinds of exchanges. And then for a lot of times, it seems easier to just go to the foundation or the team and just buy positions directly from them with some kind of a lockup or whatever. So that's all those things are an option.
Same. No, we, like Prana, we keep a very close eye on counterparty exposure. That's super important. And we try to balance out our exposures. We invest in fundamental tokens as well as options, as well as privates. And I'd say some of the changes, just to look at what's changed over the last year, Coinbase Prime makes it a lot easier to get cross-portfolio leverage. So that was something that you had to do just bilaterally, which was really painful. And now you have something that starts to look a little bit more like traditional equities, hedge fund dynamics. And I'd say there's an emerging trend of, and by the way, if this is too technical, let me know, but there's an emerging trend of tri-parties so we're starting to see some new OTC counterparties coming to the mix, and we don't have to take as much counterparty risk with them. We can do a tri-party with Anchorage or with BitGo, where it's just kind of having an escrow for settlement where you're not taking the direct counterparty exposure. So that's becoming a best practice, I'd say. And then one thing that I'd add in is when we're doing DeFi transactions, which we've been doing more and more of, we have to be fully OFAC compliant. So we use tools to check the liquidity pools for OFAC compliance or non-compliant. And obviously, there's a bunch of other compliance stuff that we do around trading that we take very seriously.
Awesome. Before we pass on to David, how has DeFi become more relevant in your specific investment strategies? One thing we've heard from some of our clients is that they're kind of going through the full regulated route or DeFi. There's not room for a lot in between. And we did see some folks starting to use DeFi a little more than before. But of course, it's not an easy position for a fund that is more used to the traditional pipelines. Has that been a thing for you or not very much?
I mean, we're right in between. So we execute things on chain if that's the easiest, lowest cost. And we're very focused because we're an RIA. We need to do best execution. So if we think best execution is on chain, we'll do it on chain. Otherwise, we'll go OTC. Otherwise, we'll go to an exchange. So we're all of the above.
It's a little bit more nuanced for us, largely because we're a pretty large asset manager and our risk threshold is maybe a little different. I don't know if there's a right or wrong answer, but I kind of ran this exercise when I started the strategy, which was, can I trade on Uniswap was like the basic question. And nobody really had the answer. We went and hired an outside legal firm and we tested like TRM Labs as a chain analysis product. I can put like a little smart contract address and it will tell me, okay, like 1% of this money has maybe secondarily interacted with someone in North Korea or something, right? And I was like, cool, like now I know. And is that okay? And nobody had the answer. They were like, well, we don't know which threshold's okay. You can determine what's good with you. And obviously, like, I work at a place where people aren't willing to risk like the firm and sort of those types of ways. So we took the position that until like FinCEN tells us which risk parameters are okay, we're not going to do things on chain, which there's obviously clear negatives from making that choice. But, you know, hopefully that kind of stuff resolves over time.
Yeah, no, sounds great. And it's very fair. So now moving to David. So David, from like a more sell-side research perspective, tell us a little more, how do you incorporate, let's say, liquidity trends in your analyses? If you're seeing anything interesting going on, how does that part of the market plays out for you?
Yeah, I would say when I think about liquidity in this space, I definitely divide it between both on-chain and off-chain sources. And what I mean by that is I definitely think about how the macro environment itself is actually impacting the space and liquidity in the space, but also think about how do these things kind of manifest themselves in an on-chain way. Now, I think from the first part, many people think that we can divorce ourselves from macro elements, which is they're like, yeah, but if you think about the correlations in the space relative to what we're seeing for TradFi assets, isn't it pretty low? Well, yes and no, but you really can't, because I think when the liquidity environment's bad for you, we've all faced it. We all saw it in 2022. It still hits us. And I think that the good thing is that right now, the liquidity environment is very favorable to us. That has a lot to do with what's going on with monetary policy. Like in the real world, the Fed is going to cut rates. I don't care when it's going to happen. It will happen, whether it's going to be May, June, second half of this year. It's already going to be priced in. And more importantly, we're going to see that they are going to be slowing down the quantitative tightening. The tapering is actually going to begin in earnest. I think those two things in particular is going to be very supportive for our space. Now, I think that I take elements of that and kind of say, like, well, how does that translate into what we're seeing inside of the crypto space? And still, I think when we are in the realm of centralized exchanges, a lot of that has to do with the world of perps. And that doesn't really take place on my exchange. I don't really care. That's like, I'm indifferent to that, to be honest with you. Like, all I care is how our market's being affected by these things. 3/4 of the volume still takes place in perps. So I think that's what's pertinent to kind of pay attention to. Now, the upside on that is that even though this is largely, say, Tether dominant, we are seeing that geographically there are new changes that are happening. You can kind of see with USDC, for example, been taking a bigger part than it used to, but still super tiny. We're talking like it went from 0.5% to like 3%. But it is showing you that the activity in the US and Europe areas are actually growing. So I think that what matters is the trend, not just what's like the absolute numbers. So I think I would take that, and then I would kind of combine it and see like, well, all right, we take that, and how does it look if I look at on-chain numbers with respect to short-long ratios, for example? Like, how balanced are those? Surprisingly, right now, they're fairly balanced despite the price action we've seen in the run-up in the last few days, the last few weeks. So I think that all tells us a story about how like liquidity is manifesting itself. Like, theoretically, you would say, like, given how much things have run up, you would think that we are really sitting on very lopsided, long-only positions directionally. That's not what's happening. So that's showing me that actually the potential for more upside this year is still pretty decent.
That's awesome. I really like this idea of kind of layering all these different liquidity environments. Can you talk a little bit about the flows that you guys have been seeing? I mean, sitting from a sell-side desk, you have the opportunity to see a very broad range of clients, maybe different geographies. We see that on the FalconX side too. Is this something you can share a little bit what you're seeing in terms of let's say, key trends from client behaviors? Is this?
That's my understanding. He's right. Yeah, so I would say that mainly I look at institutional clients, and the behavior there has been, I would say, fairly divided as far as the crypto natives versus the traditional kind of macro hedge funds, traditional players in the space. In terms of the secular trend for new adoption, by the way, it's happening, but it's happening slower than most people actually believe. But it is happening in part because I think the onboarding had been done during most of the crypto winter, and now they're just finalizing the last pieces. Honestly, I think a lot of that is going to have to do with the price action too, because in my mind, I think that these levels that we're seeing right now, 60, 65, I think this is where people start to really become interested, because there's honestly probably no better advertisement than the price action and the movement themselves and the fear of missing out. But regardless, what we are seeing right now is on the crypto native side, a lot kind of skipped the kind of large cap names in the space, your Bitcoins and Ethereums, and they went further out the risk curve. I think because what we saw in the fourth quarter of last year tend to be that they were kind of chasing after some of those returns because they found themselves underpositioned. And then when we saw a lot of the positive news starting to really build up in terms of not just the spot Bitcoin ETFs, but also the wins that we were seeing in the courts as well, they decided that they need to go for a higher beta. So we saw a lot of that, and that's been reflected in a lot of the price action. Traditional guys, I would say, though, have been more buying just Bitcoin, which is left kind of, until very recently, more in no man's land. And I think that's changing, in part because now that we've seen that there's a formalization of this asset class, they're realizing, crap, we don't have any ETH. This is potential career risk for myself, because now we have sort of a benchmark here. That benchmark, whether you like it or not, I mean, it contains Bitcoin and ETH. So if I do not have that, it's becoming a real problem. And that, I think, has been really the cause of the catch-up. And in line with the fundamentals that we're seeing right now in terms of DeFi activity picking up, really kind of started by, or rather kind of pushed by the liquid restaking token movement and other things. I think that now we're starting to see ETH have the potential to actually make probably new local highs against BTC.
Maybe I can share like a slightly different perspective, at least from a different lens. So I kind of bucket the world into two things, like Bitcoin and then everything else, right? So I'll tell you what's happening with Bitcoin. It's kind of interesting. I think a lot of the flows are coming from model portfolios. And then the way I kind of just simply describe model portfolios are, we have one in-house ourselves. These are teams that essentially say, here are some asset classes, and we're going to allocate between these asset classes based on like whatever some model tells me. And once you had the spot ETF, a lot of them decided to include Bitcoin in their model portfolio. And how much they allocate is not really, it's a function of what the model tells them, but the question is how much, it's not whether do I at that point. So, and those model portfolios tend to be generally price agnostic. It sounds crazy to say that, but like, they don't care if Bitcoin's at 50K, 60K, 70K, or 100K. So you have sort of this idiosyncratic, like weird sort of price insensitive buyer in the market. And at the same time, other people have figured it out. I think that this is happening. You're seeing it in the daily flows. So you see like perp funding go through the roof on Bitcoin, like, during Asia hours or something, right? So you kind of have like the speculative buyer that's pushing up the price, and then you have this kind of price insensitive buyer on the other side. So I think that's what's kind of happening on the Bitcoin side. I'm going to say that everything else, when I would talk to people for the last 24 months, I would kind of bucket them into three camps. Like, I love crypto. I'm crypto curious, but thank God I didn't allocate to this thing. And then I fucking hate crypto, right? Like, so far, like, I love crypto people are kind of broke the last 24 months. Like, they were already allocated. They were already kind of like losing a bunch of money. The crypto curious people were just kind of like hovering around. And I think what's happening now is like, they've missed a massive move in the market, but they kind of have this justification of saying, oh, Bitcoin spot ETF, I have a reason now to be involved. And that's kind of creating a reason for them to now get involved. It's, nobody wants to admit they should have allocated, post FTX, right? So anyways, this is kind of like a little bit of a reason. I hate crypto people. I don't know what they're doing, but when they start coming in, we got to be worried. They're set.
Yeah, we actually ran an institutional survey where like a lot of the results kind of reflected that. Like 60% of people said they wanted to allocate over the next 3 years, but really the people who didn't already have crypto involved, it was like 45%. But the really interesting number was that like 57% of people, and this was before the ETFs launched, thought that over the next 12 months, crypto would rally. That's up from like 8% like a year ago. So, and the numbers are shifting.
So maybe one thing to add to the discussion, I agree with all the things that were discussed. So We've been out marketing a lot, and I'd say still not a ton of activity domestically in the US, but we're spending a lot of time in the Middle East, a lot of time in Europe, a lot of time in Asia, and we're seeing really good interest in those geographies. That's why we're going back in a month or so. So definitely international engagement has picked up first. I'd say we're seeing the beginnings of that starting to move domestically in the US. And then the other thing that I would say is when you look at these model portfolios, we're starting to have interesting conversations. So BlackRock has a portfolio solutions product for called central banks, where they lay out equities and credit and real assets. And we were talking to a central banker a few months ago before the ETF launched. And what they said was, we said, would you guys ever own Bitcoin? And there are a bunch of central banks that have Bitcoin implicitly. So like MAS, the Monetary Authority of Singapore, they're the sole LP in Temasek and GIC, and everyone knows Temasek and GIC have been involved in crypto for a while. So that's essentially MAS being involved in crypto. The central banker said, you'll never hear that we own 1, 2, 3% Bitcoin. But BlackRock came in and they said, in the real asset bucket of our portfolio solutions, we're going to start including Bitcoin when we have the ETF. And they said, we're going to give you the option to opt out if you want to. And this banker said, we did not opt out. So here you have central bankers getting even more direct exposure to Bitcoin via the BlackRock ETF. That's something that I think it's big numbers, because what this banker said was, we allocate in kind of $50 billion increments to this portfolio solution that goes across equities, credit, real assets, and now Bitcoin. And that's just starting to ramp up. So people think about the ETF as being a retail product. It's actually not about retail, right? It's these portfolio solutions on the institutional side, on the central bank side. It's a way for iBanks to start getting involved. It's a way for the pod shops, the 0.72 Citadels, to start getting involved. So you're seeing a real institutional bid associated with the ETFs, which is interesting. And the retail side, I mean, Bloomberg had a headline today saying Morgan Stanley is considering allowing retail investors on their wealth management platform to invest. So that's not even enabled yet.
I mean, just to unpack that last point, right? There's like tens of trillions of dollars in these RIA platforms. I use Merrill for mine. I haven't actually tested whether I can buy the Bitcoin ETF in my IRA account there. But if I was on the outside and I wanted to buy it, and my Merrill guy said, Merrill hasn't signed off on this thing, and I see the price of Bitcoin going up, I'm very likely to say, all right, I'm going to go find someone else who can offer this. I'm going to move my IRA, right? So this becomes this reflexive onboarding. So if someone had this, like, I'm going to onboard this thing a year from now, 2 years from now, but I see the price going up and people are moving accounts, then yeah, like these accelerate. And so it'll be interesting to see how it all plays out.
I would just make one correction though. Like, there's about $140 trillion worth of wealth in the US, and about a third of that, around 48 trillion, is actually held within these wealth managers. So it's a much bigger number.
Yeah, so the number I've heard is 30 trillion for financial advisors with discretion. And the view is over the next few years, 50 basis points, so half a point going into Bitcoin out of that community, which is a big number.
Love to see it. That's so good. Guys, we have 5 more minutes only, and there's one more vertical in the market that I want to make sure we touch on, which is derivatives. Of course, derivatives in crypto has had a major run over the last couple of years. David already mentioned the perps market. Even Coinbase started an international exchange and getting into that business. But the options market also got really big. I think by now, the open interest in options is probably higher than the open interest in futures, which is normal for TradFi markets, but for crypto, it's kind of a new thing. What about that? I mean, perhaps for the buy-side folks here, is derivatives something you've been using more, either as a way to get liquidity or as a way to use it for hedging strategies? And what about you, David? Is this something that you've been paying more attention to recently?
I can start. I mean, we use options primarily for hedging downside, which we don't focus on in bull market regimes, and we're in a bull market regime right now. And then we also use options for hedging Bitcoin dominance. So our portfolio is mostly fundamentally driven investments in liquid tokens. And when we underperform in a bull market, it's typically because Bitcoin is having a really big move and you're not seeing broad participation among all. So Bitcoin's having a big move and it's a high dominance move. So we'll use options when we anticipate those periods of time to happen in order to hedge that exposure. And it's great because then we're participating in Bitcoin's move and we still have the mostly alt focused portfolio. So if I think about approaching the all-time high, well, if you look at what happened at the last all-time high, December of 2020, you had Bitcoin double over the course of a month, and it doubled in a very high dominance way. So we've been positioning for that type of move.
We don't use any derivatives or options. I mean, this is like a super volatile asset. I've never found a particular reason to do it other than the downside hedging component. My personal perspective is crypto does things that you least expect. So I felt like this time around, the entire market generally expected a pullback post-ETF into the halving, maybe a little pre-halving rally, a pullback post-halving, and then another 200 days, and then a real rally, right? Like it's the copy-paste of the last playbook, and the opposite is really playing out. You might get like all-time highs potentially prior to the halving. So my general view is like when you use options, you have to time it really well. Otherwise, you're just going to waste capital, and crypto is one of those assets where you just can't time things. At least I can't. So I've chosen not to really do that.
I think from my side, we have seen that, options are worth paying attention to insofar as short gamma positioning has kind of contributed to some of the price action we've seen of late. This has been happening, more consistently, I would say, over the last year, but it really kind of ramped up, I think, in Q4. It's definitely kind of presented itself more in the beginning of this year as well. I think watching the players in the space and how they use options is going to be interesting because one of the new entrants who have really been using options have been the Bitcoin miners, for example. But it's going to get more complicated for them because Bitcoin mining economics is becoming more difficult after the Bitcoin halving. And already, I think it's a lot more variable because they have ordinals kind of contributing to the fee structure as well. And when you have some more variability in terms of what you need to hedge, that becomes a little bit more complicated for them. So I think things like that could become even more prominent post-halving. So that's something I would watch. But yeah, I think like it's been a good call out to see that like options activity has really now kind of started to compete heavily with futures.
David, do you want to explain what a short gamma position is? I spent some time understanding this. Happy to help you with it. Yeah.
All right. So first of all, should I start with the Greeks in options? So
like the short answer would be like 3 minutes. Yeah. All right.
All right. All right.
As the price of Bitcoin goes up, the need for people to buy Bitcoin also goes up at a faster pace.
Yes.
Especially for the dealers, right?
When people are short gamma.
It's the change of the delta like goes up at a faster pace, but yes.
So people have a lot of short gamma positions on right now?
I think that was probably responsible for what's that? Yeah, exactly. I think that was responsible for like the move that we saw today.
Awesome. We have, 2 more minutes? So I'm going to throw a very quick question and then I'm going to wrap it up. How far down the market cap list do you guys go for investing or for coverage purposes? Perhaps it's something that could be interesting for the folks here. A lot of builders, a lot of newer projects. So just very quickly, how far down do you go? And yeah.
For our core positions, it's really 100 million and above, but it's driven by liquidity rather than market cap. But then we have a kind of liquid venture part of the portfolio where we'll go quite small, but we'll also take a relatively small position.
Yeah, for us, like we want to be able to liquidate our portfolio within a certain period of time for a vast majority of our book. So it tends to be, a few hundred million in market cap and above. But the simple way we approach the space is really by saying, what do we think the space looks like in a couple of years? And then let's find projects that represent that view in the right way and then go find it. So if it's like a small market cap project, we'll still invest in it. It's more about how do we source the position, size it, and, all that kind of stuff.
How far do you go when you're looking at the market? Do you look into new projects at all, or do you spend more time on the most established assets?
We tend to kind of focus more on the established assets. In general, I would say like we think more about the infrastructure layers of these things more than probably what's on the frontier, which is kind of which I rely on like Seth and Prana to actually tell me about, to kind of hear from them like what they're looking at. But yeah, certainly I think that what we're looking at the moment tends to be, I think, some of the residual themes coming from 2023 in terms of deep end, gaming, those kind of sectors.
Awesome. I think that's all we have time for, right, staff? So we're going to wrap it up. Thank you so much. I hope you enjoy the event. Thank you, guys, and
Thanks.
see you around.
Thank you.